Greetings, Fool. Sean O'Reilly here, joining you here from Fool headquarters in Alexandria, Virginia. It is Tuesday, February 9th, 2016, and joining me to talk about the unholy union between banks and consumer retailer is not only the irreplaceable Vincent Shen, but the articulate, the insightful, and the extremely well-read Miss Gabby LaPera. How's it going, Gabby?
I want to be on the show all the time. I get compliments here.
I try to build up my my co-hosts.
Thank you. I appreciate
I'm feeling
that.
pretty good about myself after doing IF for about a year with Sean now.
Oh.
I just compliment you every show. It's like, and nobody compliments me. Anyway, so welcome to the CG show, Gabby. For our listeners that may not be aware, we're kind of doing a, I don't know, is it crossover week? What are we calling it?
Industry smash up.
Industry smash up.
Refocused.
Industry, oh my gosh.
Venn diagram
Face-
week
face-
from our math nerd friend, Christine Hargis.
Insert eye roll here. So, Vince, do you think we need to buy Gabby lunch for coming on the show today?
We should. We should
Think?
do it anyway.
That's-
She's extremely articulate and well-read.
Oh, wow.
And insightful.
You guys can have some of my soup. I made soup today.
Oh, yeah. What were you talking about? You made, was it?
Moroccan tomato peanut soup. I don't know. It's delicious. if you're ever in Lincoln, Nebraska, go to the Grateful Bread, which may be called Freak Beat Vegetarian now because people were confused about it being the Grateful Bread being a bakery and not having anything to do with the band. They have delicious soup and mac and cheese there.
Did they get sued by the band?
I don't think so.
Yeah.
This is like a bunch of hippies. They're real cool though, and their food is amazing. And their cheddar scones. Oh my gosh!
Wow, she's
Just thinking about them.
For anybody
So
that hasn't
excited.
figured it out, she went to grad school in the great state of Nebraska, and she talks. I don't know. You had a good experience, right?
Yeah, Nebraska is nice. Vince and I were just talking about Nebraska. Nebraska nice is actually a thing.
Oh, anyway, okay. So, Gabby, as you know, Vince and I usually chat about all things consumer goods and investing in companies that more or less face the end consumer. You, of course, usually share investing insights for the banking and finance sector. Fortunately for our listeners today, most consumers happen to also have bank accounts, and for our first segment, use credit cards to pay for their Starbucks lattes and trips to the grocery store. You've got some useful insights, as I understand it, regarding credit cards. So first, what do consumers need to know about this? What's going on in the credit card industry and all that good stuff?
So generally what's going on in the credit card industry, I'm actually going to refer you back to a show that we did earlier in January. I think it was the first show of the year where we talked about electronic transactions. But more specifically for consumers, there are some kind of tricks to credit cards that you should know about. So
Because I just got pre-approved,
oh my god,
and I feel really good about myself.
oh my gosh, those things are, you get those mailers in the mail and they're like, congratulations, you've been pre-approved for
Me?
$25,000, and you're like, I only make like $40,000, but that seems reasonable. I should totally have a $20,000 credit limit. Of course, that's obviously based on your credit score from before. But credit card debt is nothing to mess around with. I think a lot of people don't realize that the average interest rate on credit cards is 15.18%
That
for
low?
the last quarter. That's the average, so that means
okay.
there's some people with a lot higher.
You got it.
Yeah, and we'll see too, talking about some of these, these retailer-focused store brand cards. The interest rates are
Don't
even
tell
higher
them,
than
Vince.
that.
That's later.
They're even
Okay.
higher than the 15%, right?
Yeah, no,
yeah, it's
a
bad.
lot of the times those are in the 20s and 30s. And that's actually something that consumers should watch out for. When you're offered something like a store credit card, a lot of the times they're like, you get 30% off on your first big shopping thing, and sometimes we'll send you points. But a lot of people carry credit card debt, and with the interest rates being as high as they are on those cards, it's not the best idea.
Even every time I check out on Amazon.com, which is surprisingly frequent nowadays, because anyway, they pitched me that Amazon card, and
Yep.
they're like, "You get $30 off this purchase." I'm like, I take out another credit card just for $30 off. Like, what's the anyway? So backing it up a little bit, Gabby, what are the average number of credit cards that the average American has outstanding?
So the average number of active credit cards a consumer has for bank cards, which is like the ones that are branded Visa, MasterCard, those guys, that's 2.24 per person. And for store cards, which are like the Target Red card or like that Amazon card, it's 1.55 per person.
Unbelievable. Okay, so Vince, you were doing some research before we came in on the massive amounts of money that stores make off these credit cards. I get pitched a card every stinking time I leave the house, it seems. Why are they doing this?
All right, so I kind of look at it like this. So in the past, you had other ways of doing loyalty programs, where it was like points or things like that. And now with Amazon, for example, you have Prime, and they've already espoused the benefits that they've seen from that in terms of Prime members spending more money, things along those lines. Well, I think in the ultimate idea behind some of these cards is to build that loyalty, where it's like you get perks, be it points or a discount per purchase. People who have these store brand cards will go to whatever retail they have it with and shop more often. And the thing is, a lot of these bigger retailers, the ones I want to talk about, like Target and Macy's, make quite a bit of money from this. So even though both of these companies have agreements with actual banks like Citibank, TD Bank, to manage, and they actually own these accounts, they have the retailers themselves actually have to help with things like promoting and other more administrative stuff, but they get tons of money. So Macy's in 2014, for example, generated over $750 million in reduction to their SG&A, which is how they record it in their financial statements, from these like affiliate fees that they receive. And the same thing with Target, where they have been able to enjoy like really good penetration with their Red Card. So I think it's like some 20% of their purchases.
They were almost violent at one point promoting that thing, by the way.
Yeah, every single time you go to the checkout line, if you don't have one already, they will mention it to you. And again, the same situation for them. They're making hundreds of millions of dollars in these agreements, and they're not even managing, the main accounts under these cards. So it's very profitable for them. It has the side effect of the building that brand loyalty, having shoppers coming back because they get those discounts or whatever, and it's very powerful.
Yep. So Gabby, I actually knew a guy who he was like irrationally loyal to General Motors. He like, oh yeah, I got this GM credit card and they're giving me points towards buying a new truck. I'm like, I went to college with them anyway. It's literally endless. Like Macy's only gives you coupons if you use the credit card. Like it's just nuts. So what's going on in the private label credit card industry today? Who issues them? Who's actually putting up the money? Is this a good business for the financial institutions still? Because obviously it's great for the retailers.
Right. Well, let's back up a little bit. For our listeners, private label credit cards are credit cards that are branded as whatever store they're from. So it would be like the Amazon
Macy's
card
or
the Macy's card. So it's not affiliated with like a Visa or a MasterCard. And typically with these cards, there's like a couple different types, but the one that I think you're talking about is the retail card, which is they can really only use it with that merchant.
Right.
They can't use it anywhere else. They do have some that are called dual cards, which you can use at a merchant and then the specific merchant that it's been issued for, and then other places, and it works as a regular credit card there. But the main provider of these private label credit cards is a company called Synchrony Financial, which funny you mentioned GM because Synchrony Financial got spun off of GE.
Oh, wow. Lots of generals.
Yep.
Yeah. What? So do they have like a monopoly? Like, do I want to go buy the stock?
I'm not going to tell you to go buy it.
Okay.
Because I can't give you direct financial advice.
You want to go to the water cooler later and tell me? Like,
they were very clear about that when I got onboarded. Eric Stadnick, our lawyer, was like, don't.
Yeah.
I think that was the whole talk was just him going to don't, please, don't. But so they got spun off of GE. They're doing okay. The retail cards, the dual cards, that's a big part of their business. And they have deals with people like Chevron, Amazon, like really, really big names. I don't know really how long it's gonna
be good. Yeah.
Well, do you think?
It seems like. Go ahead.
Oh, I think that it's interesting too because you have some people kind of changing the model a little bit with Starbucks, for example. I believe I'm not a part of their their payment app, but that's all prepaid, right?
Yeah.
So I understand that it's kind of different, smaller size purchases. You're not buying like an appliance, for example, through this kind of system. But for some of these retailers, maybe they kind of convert to this system where it's much more interactive, mobile based.
Yeah. And then one of the benefits of that, of each retailer having their own like method, is that they get a lot more data on people.
Yes.
Because I'm sure like the bank partners with them and provides them with some data, but like having their own set of data on those people, that's huge.
Mm-hmm.
Done.
And they've also done a study showing that those loyalty programs that are easy to access on your phone are also a major benefit for those retailers.
Mm-hmm. Probably just in terms of the adoption rate as well.
Exactly. That's actually what like Walmart and their little consortium of friends with their mobile app that's supposed to compete with Apple Pay are trying to do. But that's not quite rolled out yet. So we'll see how that ends up for them.
Yeah, cool. Well, before we move on to talking about what's going on in housing, I wanted to point our listeners to focus.fool.com, where you can take advantage of a discount on the Motley Fool Stock Advisor newsletter. This works out to $129 for a full 2-year subscription. Once again, that is focus.fool.com. So, Gabby,
Yep.
Vince and I have been anxious to talk to you about what's going on in housing and mortgage lending. This is obviously a huge part of the economy and affects an even bigger portion of the economy because once you buy a house, you need, a new TV, furniture, maybe even a dog. So is housing back since the Great Recession? How hard is it to get a mortgage? I saw that Rocket Mortgage thing during the Super Bowl.
I think everyone did.
Yeah. They really struck a populist tone with that. They're like, we can make America better.
I was talking to someone else in the office the other day, and they were like, I thought that it was a commercial for The Big Short. Like, that's what I thought it was for.
It was a little bit concerning how nonchalant they made the idea of, I'm going to just click this button on my smartphone
Oh my God.
and and get a mortgage. It was a little bit concerning how they make it seem like this trivial matter when it's not at all.
A $400,000 purchase should not be trivial.
Exactly.
Yeah.
Gabby, can I still buy a mortgage-backed security if I want? Because I really want to.
You just want like one
I'm kidding.
mortgage-backed security. Like,
I just want the whole
I don't
thing.
even know how you would go about doing that. But yeah, MREITs are always an option.
Yeah.
MREITs are mortgage REITs,
Yeah.
real estate investment trust. I don't know if you guys ever talk about this, so I figure I'm just going to spell out
No, go nuts.
what all the acronyms are.
No, I think that makes sense. We
have
do
a
not
lot.
delve into that realm very often.
But no, so the housing market in general right now, it hasn't reached pre-recession levels. I think back then, home ownership rate was around 69%, like in 2005.
It's in the low 60s now, isn't it?
It's in the low 60s.
Yeah.
And I think the lowest it ever got was like in the 50s, but it has gone down from last quarter. The one thing that we are seeing a lot more of, though, is renting.
Mm-hmm.
So if you
Said the 3 millennials sitting at a table doing a podcast.
It's true, especially amongst millennials. That's the group that you're seeing the most doing the most renting, because I mean down payments are expensive on houses.
And, I mean, correct me if I'm wrong, the rule of thumb with homeownership is you shouldn't buy a home unless you're planning on staying in an area for 5 to 6 years. I don't know about you, but since leaving college, I moved 1, 2, 3, 4, 5, 6 times.
Yeah,
Like,
it's a minimum of 5 years. What a lot of people don't think about when buying a home is all the closing costs involved. So in order for that to average out, you need
so that's
to
like
stay.
5-10 grand. Yeah, minimum.
Yeah, you need to stay for 5 years in order to recoup your losses when you sell your house again, assuming that your house goes up in value.
Which is a dubious assumption.
So you guys mentioned millennials, obviously younger people. I can understand starting their careers, building out, their net worth and their savings in order to handle some of these down payments is difficult. 20% even on a $200,000 home. I think that the median or the average for the U.S. is like $150,000. It's still a pretty decent chunk of change. But you sent me an interesting story that I read for the Bay Area, Gabby, about some of these I don't remember what they called it. It was very like
It's like zero down home loans. Or
Oh, that's
something like
right.
that.
exactly.
Well, then it was variable interest rate too. What were
yeah.
you saying? Like, I was like, why are we doing this again? It's been 7 years.
Yeah, so this is the San Francisco Credit Union. A lot of the homes in San Francisco are very expensive.
I think it was like average $1 million.
An average
in
of,
that
and
area.
so to get a down payment for the 20% down payment, that's $200,000. And even for people who are working in the tech industry there, that's very, very expensive.
Sure.
So there's this credit union saying, we'll let you get a home loan for 0% down. And they're saying, like, don't worry, like, our standards are super stringent. But you look at it and it's a variable rate, which is not great. So you really want a fixed interest rate if you're getting a mortgage. A 30-year fixed interest rate, that's probably the lowest it's going to get.
Well, it's even worse because the Federal Reserve just increased interest rates for the first time in a while,
Right.
and supposedly they're going to keep going. So
Yeah, I don't think they're going to, like, super duper accelerate
Right.
that, though. And interest rates are, like, at a historical low. They're so low right now. It's still almost, like, negligible.
yeah,
But that doesn't mean like in like 30 years when you're still paying off this house, like maybe interest rates are a lot higher and suddenly you're paying a lot more in interest a lot later. Also, like Vince was saying, it does seem generally on its face like a bad idea. Like if you can't even come up with a little bit for the down payment, what are you doing buying a house? You know,
It's bad.
And I think, I'm not sure, but I'm pretty sure that those must come with PMI, which is private mortgage insurance.
Yeah.
Which is basically what you have to pay on a mortgage, on top of a mortgage.
Unless you put what, 20% down?
Unless you
isn't it?
put 20% down. That's exactly right.
Who's, because I remember a couple of primary mortgage insurers. This is back in my first looking at the stock market days, but a couple of primary mortgages, in fact, all of them, like went under. There was actually PMI Group, I think, that was 2000. I'm pretty sure they're gone. I mean, what's going on in that industry right now?
Honestly, I have no idea. We, like the people in my bureau, the financials bureau, sat down yesterday and tried to find a PMI provider. And it is incredibly difficult to find one. It looks like the banks are the ones providing it.
And they're just charging the money and self-insuring or something.
Yes.
Yeah, PMI Group is on. It's bankrupt. Yeah, they're gone.
Which is, oh man, the 2008 recession, just a little road bump for them.
Well, and I know a new company got formed, and this is like me reaching in the cobweb of my mind, but I know that George Soros like helped create one, and they're going to have an IPO. And I just found Radian Group. They are finally starting to make a little bit of money, but they were they were almost bankrupt in 2011. Anyway, I think they just did a reverse stock split too. I would think that industry would be super profitable now, though, because everybody's like, oh, wow, the whole industry just crashed. We can actually charge money for the insurance now or something. But
Yeah, and I mean, property values are going up in certain areas of the country. And the thing with PMI is if you can avoid PMI, that is really ideal because one, you're paying extra money. Two, they're super hard to cancel. Like you go online and you look for how to cancel PMI.
Game over.
And it's like people are just like complaining. There's like, I have no way of canceling this. I've tried for like a couple years now. So if you can avoid it, I would highly recommend it.
Putting the money down. So for all of our consumer goods investing listeners who obviously, might own shares in a Home Depot or a Lowe's or something, bottom line is, so it sounds like housing's not gangbusters, but it's not bad either.
Yeah, no, it's chugging along. I mean, technically it went down last quarter, but like...
It's a quarter. It doesn't matter.
Exactly.
Cool. All right. Well, that is it for us, folks. If you're a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Again, that's industryfocus@fool.com. As always, people in this program may have interests in the stocks that they talk about, and the Motley Fool may have formal recommendations for or against those stocks, so don't buy or sell anything based solely on what you hear in this program. For Gabby LaPera and Vincent Shen, I'm Sean O'Reilly. Thanks for listening, and Fool on.